All right, joining me in the studio now to react to the inflation numbers is the Managing Director of Cowry Asset Management, Mr. Johnson CHUKWU. Mr. CHUKWU, you're welcome, sir. Thank you so much for joining us on the Global Business Report.
And thank you for having me.
Yes, you're welcome, sir. So we're now going to take a look at, I believe, some of these figures here. So, Mr. CHUKWU, let's go through some of the numbers now. As far as the headline CPI figures, year on year and month on month. So what are we looking at as far as the figures are concerned?
Well, if you look at the year-on-year figure, I mean, we're looking at about 12.13% year-on-year growth in inflation. Inflation rate at 12.13% in January.
Yes.
That's an increase, further increase of 0.15% when compared to the 11.98% we had in December. And the basic thing we have to look at is that we have seen consistent increase in inflation month on month for quite some time.
Okay.
And it's been driven by a single factor,
right,
and that's largely the border closure. But unfortunately, other factors are going to come into play as we move down the year. The pressures we've gotten up to January were driven by border closure, increase in the food prices. Of course, you saw the food price inflation, it moved to 14.85%.
Yes,
the highest we've seen in the recent past. And principally because the shutdown of the borders led to an increase in the price of domestically produced food items, because there's been a shift in consumption.
Yes.
If you look at a breakdown of the major increments, you see it came from things like bread, cereals, potato, yam, okay? And these are basically locally produced foods.
Yes.
So what you've seen is that consumption has shifted from products like rice to locally produced goods.
Okay.
But unfortunately, we're gradually moving towards the planting season. And that simply means that the prices of these locally produced foods will increase further, apart from other pressures we're going to discuss as we move forward in our conversation.
Okay. Now let's also look. Let's see now if I think we're going to move to our next next slide here. You mentioned that one of the main drivers, was food inflation. So we look at the food sub-index now, 14.85. So that's a pretty big jump as far as that's concerned. Yes.
Yes, absolutely. Because what we are seeing is that the core inflation is actually just about 9.8%. Which is excluding the volatile agricultural produce.
Yes.
Well, that shows you that the major pressure, if you compare a 9.8% to a 14.85%, which is what you have in the food inflation basket, you can see the pressure is coming from food items and locally made food items. So we have seen a shift in the consumption, like I mentioned earlier, from the likes of rice to local food. If you look at the items that are driving the food inflation, you see bread and cereals, fish, meat, potato and yam.
Okay.
And these are basically what you can call a shift in consumption.
Yes.
Okay. And because there's a shift in consumption, there's no commensurate increase in production of these goods. And their prices have to adjust upwards, which is what drove inflation in the month of January. Okay,
and let's say what our next slide is here, as far as these numbers are concerned. Okay, so I think you already mentioned the core sub-index as well, 9.35. That's also, we also saw that's up from 9.33 in December.
Yes.
So also, and that's excluding volatile items, correct?
Volatile agricultural items.
Okay.
Which are things like potato, yam, and what have you.
Okay, so now also beyond core, I think we also got some more figures now as far as the urban so urban and rural, a bit of a differentiation here. The urban index that increased 12.70 from 12.62. Same thing with the rural index as well. We saw increases in both of those divides. Any thoughts on those as well? I mean, it was expected, yes, if the headline inflation number was going to be increasing.
Yeah, you see, basically the different way you have this discrimination or differences between the rural inflation and urban inflation. The rural areas do not have to incur some costs that the urban consumers have to incur to get the food they eat.
Yes.
I remember the food mostly produced in the rural areas. We've actually talked about that the pressure is coming from food inflation. The impact of food inflation in the rural areas is not as severe as it's in the urban areas. And that's why we've always had consistently, the urban inflation has always been higher than rural inflation. You saw an urban inflation of 12.78% and a rural inflation of 11.5%. Both inflation indexes actually increased in the month of January. But the increase in urban inflation is higher than that of rural inflation because the food is produced in the rural areas
and then taken over
to the way. So the cost of transportation and also increase in the cost of transportation also add to the higher price levels you see in the urban areas.
Okay, and that's another conversation about roads and the issues of the infrastructure issues that we're facing. Okay, the states, this is a wide-ranging conversation here. CHUKWU showing one of the highest levels of year-on-year increase as far as food inflation is concerned. CHUKWU, Ogun, Nasarawa, and then the slowest rise, Bayelsa, Delta, and Benue. I think when we talk about the states, it's different, 36 states, different variations, different stories as far as the states are concerned, yes?
Yes, basically, you look at what are the components of the basket that are measured in those states. In places like Sokoto, there's a lot of consumption of cereals in a place like Sokoto.
Okay.
And if you have to move the food items that are taking the pressure, like tubers, potato, you're going to move them from North Central. And remember, Sokoto is at the tip of the south of the northwest.
Yes, yes.
So the additional cost of transporting those items to Sokoto will be much higher.
Okay.
In the past, small good food items like rice were depressed the inflation rate in places like Sokoto. And also that also applies to Ogun State. Remember that Ogun is a border state, similar as Sokoto is a border state.
Yes.
So these states used to enjoy lower price of items like rice, because they serve at the first entry point when those items are small goods. When the border was closed, it became difficult for them to continue to attract those lower cost food items like rice.
Yes, yes.
And that's why you are seeing border states like Sokoto and the Kebbi recording high inflation rate than you have in other states.
Okay. Now, if we skip ahead now, I want to get to our economic snapshot. Yes. Now, okay, so the main thing I want to look at here is inflation now at 12.13. Yeah, of course, we've got our GDP for Q3 at 2.2. We've got full year 1.93. But interest rates, I wanted to get your thoughts on the fact that this now, the impact on real interest rates, what this means with inflation now ticking upwards to 12.13.
If you look at the measure of interest rate, which is the basic thing, the risk-free interest rate,
yes,
the treasury bills rate.
Right.
Today, you are seeing treasury bills, the 91-day bills about 3%. The 364-day bills are about 5%. So if you compare that to the actual inflation rate of 12.13%, people are actually suffering what you call negative real interest return,
right,
on their investment in money market instruments.
Yes.
And if you look at what is going on now, is that we are beginning to see an adjustment in portfolio by those who have the resources. And what you are seeing is that you're seeing pressures on FX. People can no longer invest their liquid assets in money market instruments at current rate level. Because simple thing you are saying, look, if I have 100,000 naira today, and I have a product I can buy for 100,000 naira,
yes,
and I decide to keep the money in the bank, at the end of 1 year, I will get 105,000 naira.
Yes.
But by the time I go to the market to buy that same product, I have to buy it at 112,000 naira.
Right, so it's increased.
So it simply means the 100,000 naira can no longer afford what it would buy today
prior.
when I save that money. So I'm left with one option: either consume today or convert that money to another currency, yes, that I'm sure of its value. And that part of the pressure you are seeing, the FX, it could be as a result of people converting their local currencies to FX in order to mitigate the fact that, the effect of negative real interest return.
Thank you so much for that. So real quick, we've only got about a minute left. The IMF downgrade for GDP for Nigeria for 2020 full year of 2.5%, they've gone down to 2%. Can you quickly give us your thoughts on why the IMF has taken this decision?
Well, IMF came up with several factors, one of which is that we've seen crude prices have actually trading about $54, yes, $54, $56 per barrel. So, and we're seeing a negative or current account deficit in the sense that our total export value is now lower than our imports. So for the past 2 years or a year and a half, we've seen a consistent negative or deficit balance of trade, which ordinarily was not the case. So it simply means we are having outflows from our trade balance, and we're also having capital outflow. As a result of the reduction in interest rates, some of the portfolio investors are no longer as aggressive as they were on Nigerian money market instruments. So you are seeing a reverse capital flow, you are seeing lower deficit reserve, and they're also seeing pressures on inflation. So all this added together is why IMF is projecting our growth will slow down further from 2.5% to 2%.
Mr. Johnson CHUKWU, CEO of Cowry Asset Management, thank you so much for joining us.